So good evening, everyone. Welcome to tonight's webinar. For those of you that have been with us before and for those of you that are new, I'd like to draw your attention to the disclaimer on screen that I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorised to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise listeners of this content to seek their own advice. So tonight's webinar is called Master the ECB meeting, the ECB meeting being tomorrow. And as we see, so there's the structure on screen. It's been an up and down week already, certainly for tech stocks, as the market tries to digest the move in yields and how the global economies are going to emerge from this pandemic. We have a big day tomorrow with the ECB meeting. And the press conference afterwards, and then following Wednesday, we actually have the FOMC, so two really big central banks. So tonight, as you can see from the structure on screen, Morris is going to discuss the divergence in thinking between the ECB and the Federal Reserve and what this may mean for euro tomorrow and for the week ahead. He's then going to pass on to Richard. Richard is going to explain a new moving average technique that you can use with your intraday trading, and then he's going to update you on EU stock markets, the major US ones, and also a few of euro dollar and the euro crosses. So as always, I'd like you to put your questions on the chat the minute you have them, so we know that what we've got coming at the end of the webinar. And brilliant, I'll pass you over to Morris. Morris, over to you.
Thanks, Chris. Welcome back, everybody, and any of those that are new to this, welcome indeed. I think we have got a pretty busy market going on at the moment. We've got a lot coming up, as Chris said, with this week. And I think one of the big things the market's been waiting for is to see exactly what we're going to get from the ECB. Now, one of the things that's been a major player at the moment is the difference, or divergence, if you like, between US growth potential and data and spending against that of the EU and the ECB. Now, they're very far apart in the recovery. And if you look on the ECB side of things, the euro is still in a bit of an economic coma, brought on by the list there: pandemic lockdowns, slow vaccination rollout, usual European red tape, of course. And realistically, it looks like maybe some of the economic forecasts we get from tomorrow might show them heading into a double dip recession. Now, at the same time, on the flip side of that, we've got some pretty hot US data coming out recently. Certainly the forward-looking data looking very strong, the PMIs, the ISMs, those sort of things. We've got huge monetary stimulus going on. Huge fiscal stimulus packages just being passed now, and then another one in the background bubbling away. And you can see on some of the forward-looking data here just where the US is against Europe, and it's leaps and bounds ahead. And realistically, I think one of the big banks today said they expected, I think it was Morgan Stanley, said they expected the US economy to be back where it was pre-COVID the end of this quarter. Now, that is a pretty impressive V-shaped recovery, which I do not see happening in the EU, for your guide. So I think what we've got here is growth expectations in the US around 6.5%. Now, to put that in context, that is probably higher than we're going to see in China this year. So I think that's outstanding, and it's obviously coming from a very low base. But the EU, potentially 3.8%. I'm not sure if they're going to make that. That could even be optimistic in my view. And so we've got this divergence of growth, and we've got divergence of yields as well. And we'll talk more about that as we go on. So we've got the ECB tomorrow, and then we've got the Fed, which is the FOMC meeting the week after. Now, I think the key points here are that the ECB is probably not going to do a great deal, or if anything, with actually rates or QE, but I really do think that most of the move that we may get in bonds or the euro is going to come out of the press conference from Lagarde. So what are they going to give us a heads up for at 1:30 GMT tomorrow, and how is the market going to respond for that? So these two regions are on sort of polar opposites at the moment, and the attitude towards this at the moment are also starkly different, which gives us a potential move on the euro still. We've seen euro underperformance, but the approaches of the two central banks, we've got one on the left here, the ECB, worried about higher yields damaging the potential economic recovery, and we've got the Fed under Mr. Powell on the right here suggesting those higher rates are just a normal occurrence in a recovering market and it's healthy. So he's going to let those yields run, and it seems like Lagarde might want to do something about those in the euro area. So I think that's a key point here. Now, I think, you know, when we look at the path of recovery, it's very interesting that we've had a recovery in certain sectors and not all indices rising, as you've probably been witnessing this week. We've had some fairly turbulent markets. Now the Russell, which is the small cap, this is the recovery stocks, if you like. We saw this rotation out of tech stocks. NASDAQ fell 11%. We've seen the Russell up 44% since November, the NASDAQ up just 14. That shows you the rotation going on. But within this, I think it's really important to sort of suggest also what sort of role yields play in all this as well. And I think if you look at that square there, that volatility in there was caused by yields. And this is where we need to be careful, because higher yields can destabilize all markets, even the growth story at some points, because that volatility in there came from this steep rise in US 10-year yields. As prices go down in bonds, these yields go higher. That chart there is actually showing about a 1.6%. We've had a US 10-year auction today, and we've seen yields drift down back to 150, 1.5%. So quite a steep move down today. But interestingly, we're not seeing stocks really race higher. But again, the NASDAQ underperforming again today, the Russell and indeed the Dow. So I think really it's very important that you understand the impact that bonds can have, US Treasury 10-year bonds especially, which are the global benchmark for bonds, the impact they can have on all risk assets. And I think, you know, we need to look at really where the yield problem is. Now, if we look at this, we're seeing quite a big confidence in the recovery globally. So what we've got is global yields going up. The difference is, and the reason why we're seeing some strength in the dollar recently, is that actually US yields are going stronger than most others. But the Fed does appear very relaxed about that. And this is a natural reaction they see. But what's happening is that those weaker economies are also seeing their yields rise. And this is very disconcerting for the ECB and even the RBA, who mentioned in Australia last night that they were concerned about this. And you know, they were sort of possibly going to act and saying that the market was getting ahead of themselves by pricing in rate hikes. So we have very, very different attitudes at some of these central banks. Now that throws up some interesting possibilities for the currencies as well, because yield divergence, or the difference between a stronger yield and a lower yield, can actually make quite a bit of difference. Now, as you can see, this EU-US rate differentials are widening again, and I think this is going to keep the euro offered, particularly into the meeting tomorrow. So this growth divergence is also playing a role. We've got much bigger growth expected in the US, much bigger stimulus, which is happening now. Where is the stimulus from the ECB, from the EU? Not there yet, and it's dwarfed by that's coming from the US as well. So this lower euro is what the ECB wants to see, though, and I do ask myself quite a few times whether the euro, although never admitted, would be part of their central policy ideas as well. And I do think that's the case. They won't admit it, but I think it certainly is. And I'm not sure what they can do to keep these lower yields down, but I think they need to be careful. We are starting to see the euro start to break down. We did trade back up around 119, but I think that the market here is understanding the differences between the two central banks, and that's why we've seen that move down that you can see over the last couple of days. And I think that could possibly even extend if Lagarde is particularly dovish tomorrow. So I think price actions into any ECB meeting can be choppy. See what she says, but I can't see the ECB being anything but uber dovish, and I think they want yields to react, and I think they want the euro to react. So I think she's going to be pretty strong on the rhetoric. So I think what we have had is a few speakers coming out being quite aggressive on this. They've actually suggested that, I mean, in one case, the guy was suggesting they may have room to cut rates. I do not see that happening anytime soon. There's no justification for that whatsoever. Using additional PEP, this is the Pandemic Emergency Purchase Program that they put in place. It looks like QE, it walks like QE, so basically it's just called something different. And I think realistically, it's interesting because whilst they've been screaming about doing more, the last 2 weeks they've actually reduced purchases. So either the ECB is totally incompetent, I'll leave that to you, or there's some technical issue for that. I just do not get it. I'm still scratching my head why they are doing less when they're shouting to do more. So that's an interesting thing. Hopefully, one of the journalists might actually come up with a sensible question and ask them why. So the press conference is going to be the potential where the damage could come from if she wants to sort of really go uber dovish on this. It's going to be the assessment of the state of the economy is going to be looked at very closely by economists and traders alike, investors. I think they're going to have to accept that the short-term inflation is going to be there. I don't think there's any getting away from that. They are saying it's going to be transitory and a one-off. It'd be interesting to see what the forward assessment on inflation is, rather than just look at the growth forecasts. And I think this time round, the assessment on inflation could get more of a reaction than the assessment on the recovery expectations and growth. So look for any comments on the strength of the euro. I do think there's a possibility of that. They never target the euro. They say they don't. Yeah, right, okay. They may not mention it, but they actually have that at the center of many things they do, and they have done in the past, but it's not apparently policy. So market expectations into this, probably not much of a move on the actual official rates, but the market is expecting them to try and push yields down with rhetoric. Be interested to see if that happens. You know, and these bond purchases, they've got to be asked about that. So it'd be interesting to see what their explanation for this at the bottom is. And the markets are starting to price some form of action by the ECB, looking at sort of the bond markets and the euro itself. And I wouldn't be surprised if, you know, even if they don't say a great deal, the fundamental structure between the US and the EU look pretty solid to me. And I think, as you'll see later from my friend Richard on the technical side of things, I think the technicals are beginning to float that way as well. So, you know, I think that it's a pretty strong argument at the moment. Underperformance in the EU could even see some of the crosses like Euro Sterling or Euro Oz start thinking down. But just bear in mind, you know, it's not always against the dollar. I mean, for instance, you know, we've got a lot going on with oil. So if you're thinking of selling the euro, then maybe look at the CAD to sell against if you think oil's going to hold gains, or you know, and that's a higher yielder as well. So it's a natural trade out there, or possibly even Euro Oz or Euro Sterling. And these markets are beginning to move. Euro Sterling is not far off its recent lows, or I think around 85.37, if my memory serves me right. You know, if we start breaking down through there, this chart is going to continue to underperform. So, you know, I think you've got to pick your oppositions. I mean, whilst the euro and the yen and the Swiss remain weak, I think they're all viable things to sell. But there's some other things apart from the dollar necessary to buy against, although the yield differential on the dollar is probably the strongest out there at the moment. It depends how convinced you are of a rising dollar from here. So I think that's a really interesting way of looking at that. And I think, you know, very briefly, because you guys aren't with us next Wednesday, I think the FOMC on the 17th of March, this could be quite a wild one. I'm not quite sure what we're going to have, but the Fed wanted to speak to us just before the blackout period. And what he said then was very much sticking to the script. They're not worried with yields rising. They see it as a natural move towards a recovery. They're welcoming the fiscal stimulus, although I don't know if any of us, or maybe a lot of us, are underestimating just how strong that stimulus is going to be. But I think they see no move on rates for a while. I think there's some technical stuff that they may have to look at the very short end, but I don't think that's going to be wrapped up as a policy move. There's some stresses in the very short end which which are a bit concerning. It's very technical. It's in the repo space, and it may have to be fiddled with. But to address the rising yields, Powell said this: I would be concerned by disorderly conditions in markets. Now, if this persistent tightening of financial conditions did actually happen, it would probably come about by a very quick move in bonds rather than just the actual price it moved to. So if we went from where we are tonight, around 1.51% to 2% in a week, I think that would be a problem. But I think what we're seeing at the moment, and if we can hold around this 1.5, 1.6% for a while, I think he's going to be pretty happy with that, to be honest. And again, he keeps reiterating that the unemployment level needs to get back to full employment, and inflation in their vehicle of choice, which is core PCE, which is literally floating around 1.5% at the moment at best, or 1.6, needs to be above 2% for some time, maybe a period of months, and that could take some time. So right at the back of all this, the Fed is going nowhere just yet, or at least that's what they're telling us. So it'd be very interesting to see, hear what Powell has to say in the news conference after the rate announcement, which is half an hour later on that Wednesday. So that's a quick summation for you. For those that are around on Sunday, please join us. We'll be talking about this again. We'll have a bit more information, what we're looking forward to in the week. So, I think if you want to prepare for the week properly as a trader, then come and join us on Sunday night. And on that note, I'm going to sort of pass you over to Richard, who's got some very interesting technical updates for you. Rich?
Great, thanks very much, Mo. Good evening, everybody. Hope you've had a great week so far. I thought what I'd do this week is to split my section up into two pieces. Later on, what I'll do, I'll look at the live charting system and basically sort of take a look at the Euro crosses and the DAX, for instance, ahead of the ECB tomorrow, and just to sort of put some extra meat on the bones that that Morris has so very expertly developed for us, so we can see the sort of levels that we'll be monitoring coming into the ECB, and to basically establish where the directional risks are and where the trends are beginning to materialize as we come into such an important piece of information. But before then, what I wanted to do was to basically look at a trading approach using technical indicators, i.e. moving averages, but something that takes out the analysis, if you like, of price, and basically just using moving averages to smooth out price action, to establish where the directional risks are beginning to materialize, and to actually generate trading signals that we can follow on an intraday basis to highlight where the more aggressive trending conditions are beginning to materialize, and with the markets that we can take advantage of in terms of that trending condition, and where we can look for potential to establish trades based purely on moving averages and the trends that moving averages give us. So basically, what I'm going to look at is a strategy that uses 3 exponential moving averages. And exponential moving averages are used because they are, obviously, we've discussed in the past, the emphasis is on the latest piece of information, so the latest data that has greater influence on the direction of the moving average. So they react much more quickly to price changes than a normal simple moving average does. So we can see some potentially earlier signals developing, and we can react to that. So basically, this is a system that I've used in the past from a trading perspective, and it plots 3 exponential moving averages on a 10-minute chart. So we're looking at short-term intraday signals, and we use a 5-period, a 20-period, and a 50-period exponential moving averages to generate the signals that we're looking for. And very simply, there are set criteria and rules that we need to see fulfilled, but they are very simple to actually spot on the charts and to actually look at and generate trade signals as they begin to materialize. So the buy signal comes when the 5-period exponential moving average crosses from below to above the 20 period, and price and the 5 period and the 20 period moving averages are above the 50 period exponential moving average. So in other words, we have a short, medium and longer term trends, and that we're starting to see the short and the medium term as well as price break above the longer term trending condition of the market to reflect the potential of further strength developing within the market. Now the sell signal comes when the 5 period exponential moving average crosses from above to below the 20 period, and both the exponential moving averages and price are below the 50 period exponential. So as soon as we start to see these signals being generated, that triggers the buy or the sell signal within the approach. Now, obviously we need to go in to each individual trade knowing where our risk is. And the beauty of this approach, and something that I've always found very beneficial, is that it has set rules for placing this, not only the stop, but also the potential objective for the move. So originally, the actual approach says that the initial stop is placed below the 20 period exponential moving average within a long position, and above the 20 period exponential moving average for a short position. However, I actually found that to be not necessarily that reliable, in that you would quite often see a reaction that would see you break above and below the 20 period moving average and would actually take you out of the position, when in fact the trend did actually start to extend higher once we saw that break. If you remember back to, say, Bollinger Bands, when we're looking at a simple 20 period moving average, that mid average often acts as a support point. But because we're using exponential moving averages, we can often see that support or resistance give way, where in fact on a simple moving average, that level would hold and actually resume the trend. So the way I tended to overcome this was to use a ratio of 3-to-1 of profit against potential loss. So in other words, say if I'm trading the S&P, I would risk 10 points within price action, looking to make 30 points. So maintaining that ratio of 3-to-1 with each trade. Now, if prices move 10 points in your favor, this is the opportunity in the signal to move the stop to flat. So in other words, you're being aggressive in your risk management, and you're looking to protect your risk within price action by moving as quickly as possible back towards a level where if you are stopped, you won't make a loss on the trade, and you'll then obviously live to fight and earn the right to be able to trade again. Now, if prices continue to move higher, say the 20 points on side, you then move the stop higher once more, so that you actually then will be guaranteed a 10-point profit. So again, you're being more aggressive within your risk management and looking to protect any profits that start to develop. So basically, what we have here is the S&P on a 10-minute chart. The red line is the 50 period moving average. The blue line is the shorter term 5 period. And the black line is the 20 period. So we have the short, medium, and longer term moving averages highlighting the trending condition of the market. So we then start to see prices rising, and the 5 period, the blue line, crosses above the 20 period, and both the averages and price are above the 50 period, so the red line. So that generates a buy signal within this approach. So effectively, it's saying that the trending conditions over these time periods that we're looking at with the moving averages are turning in a more constructive, positive way, looking for extension of what should be a positive trending condition. So we establish a long at that particular level, which is 38.41.59, and using the 3-to-1 ratio, we put the target in 30 points above at 38.71.59 and the stop at 38.31.59, which is 10 points below the entry level. So we go into the trade knowing our risk and knowing what the profit potential is within each individual trade that we take. So prices then start to rally within these 10-minute periods, and prices move higher and trade to 38.51.59, which is 10 points above our entry level. So we maintain the target point, which was 30 points above our original entry, but we move the stop higher to flat, to 38.41.59, which obviously means that if we are stopped, then we'll be flat on the trade, and we can then look to re-establish the next trading signal as and when it's generated. So obviously with a shorter term activity within the 10-minute chart, we're obviously monitoring this on an intraday perspective. We're watching the shape of the moving averages, we're watching price activity, and we're starting to see how these begin to materialize. Now, as you can see, the move higher wasn't extended any further, and we saw a consolidation develop, but we remained above our stop level at 38.41.59. But then in fact, what we saw after the consolidation is that the 5-period moving average started to break above the 20 period, and obviously price and the 2 moving averages were again above the 50-period moving average. So we get another buy signal to increase longs within this developing trend. So we see exactly the same setup within the moving averages. So we add a long at this level at 38.52.41. So we're now holding 2 long positions with 2 different target points and potential objectives, 30 points above our entry level. So at 38.71.59 and the latest at 38.82.41, 30 points above our entry point. Now our stop on this second level will be placed 10 points lower. Now you'll see that the 2 stop levels are fairly close together. Now it's at this point that I would move both stops up to the higher level at 38.42.41 and look to protect the 2 positions that I've now established within trading signals. So basically, again, we're being more aggressive with the stop placement and looking to protect any profits that we see developing. So both stops now at 38.42.41. We then start to see prices continuing to move higher after this second buy signal, and we hit the target for the first long position at 38.71. So we close and take the profit of 30 points on that long position, on the initial long position, and we are now holding just 1 long at the second 38.52.41 level. And because we've traded higher, we then pull the stop up to the entry point. So again, we're protecting our profit on this developing trend, and we're looking to be more aggressive with our risk management. And that if we are stopped out on this second position, then we'll be flat on that, and we would have just made the 30 points on the first initial trade. So our second target point at 38.82.41 remains the same. So we're effectively now obviously holding a profit from the initial trade, but we've also got a free trade within this second position. Now, as prices then start to move higher, we hit the target that we were looking at, 38.82.41. So we then close that position and we move aside, and we've taken the profit on both long positions, just purely structured around the moving average signals and the types of trending conditions that these exponential moving averages are reflecting, and the types of signals that we could be looking for within a trending condition of the market. Now, obviously, we would then need to wait for another similar setup, either to the upside or to the downside, within the moving averages to generate a new signal. But it highlights the more shorter term trending conditions and where we're looking for an acceleration to develop within the trending condition of the market. So for me, it's been quite an interesting approach to use. It's often something that I used to use when I sort of was unsure of longer term trending conditions and technical signals. So I would use this from a much shorter term trading perspective, looking to offer opportunities on a short-term intraday perspective, just purely looking at price action and the moving averages to highlight the trending conditions of the markets. So it's worth taking a look at and just sort of monitoring these types of signals within the markets that you're trading. So that's the trading approach. What I'd like to do now is just flip to the Pepperstone live markets, and we can see where we're actually standing at the moment in terms of price action and how we can expect markets to develop and how we can really sort of assess where risks are developing ahead of the ECB tomorrow. And then we'll take a look at the US markets, the equity markets and the US dollar to really see where risks are beginning to materialize after latest moves. Okay, so starting with the DAX, obviously we've seen a very strong upside move recently. We've pushed to new highs and we're continuing to see increasing volatility within price action. So in other words, we're tagging the upper band of Bollinger Bands, the average is turned up, the bands themselves are widening, which is obviously a positive structure looking for further strength to develop. So as we move into the ECB, the general themes are still towards a more positive trending condition, and the risks of extensions developing as we come into the meeting and potentially beyond it, because as we can see from the weekly chart, we've now broken and established ourselves above these previous highs. So this potentially is quite an important break to the upside. And with the more positive trending conditions in place, we're still looking for risks developing to the upside. Now, this is the shorter term 4-hourly chart. Again, obviously, with prices making new highs, there is still upside risk developing. The one thing I would just be slightly cautious of from a shorter term perspective is that having seen new highs within the 4-hourly chart, we're actually looking at divergences developing within both momentum and trending. Now, this is a concern, but really to confirm it, we would have to break below this last correction low to really suggest that this divergence is influencing price action. And if we were to break below that level, it would suggest that we could perhaps see a setback and a correction materialize just as a reaction to the short-term upside. But as we've said already within the daily picture, it still looks as though we're looking at a more positive trending condition, and that any setback is likely to be limited within what is a developing positive trend now. Okay, so that's the equity market for Europe. If we now take a look at the currencies and the euro setup in particular, so obviously starting with euro dollar, the dollar strength has been obviously pretty well signaled within technicals of late. We've started to see improvement developing, and equally on the flip side, we've also had euro deterioration developing as well. We've seen euro underperformance pretty much, on a consistent basis across the board, and obviously euro dollar has been a clear reflection of that. Technically, from a slightly longer term perspective, it was the break below this last correction low last week that really suggested that a more significant shift in sentiment is developing. So in other words, having been trading in a positive trend, what we're now seeing is the basic definition of a downtrend of lower highs and lower lows. So the latest recovery failed to break above the previous high, and this sell-off is breaking below this correction low. So we're seeing more negative themes developing. Yes, we're seeing a rally develop so far this week, and considering the extent of the sell-off that we've seen over the last couple of weeks, that's perhaps not too much of a surprise. But the important point for me is that there's no evidence of a positive sentiment shift within the euro and within the euro dollar in particular. So the risks are still skewed towards lower limited upside and lower limits developing in due course. Now, this may need to be once we've seen the ECB out of the way, and you can see within the 4-hourly chart that again we've unwound what were overextended downside conditions. Trending conditions on the MACD are still more negative. So the rally back is now approaching the resistance of the upper band around the 119.40 level, and that also relates to a Fibonacci retracement of the latest sell-off. So again, the risks are still skewed to the downside in terms of these signals that we're seeing generated. So again, I think the risk is still skewed very much towards, yes, we are seeing a recovery develop, but the overall risks are still skewed to the downside, and that the evidence really does suggest that we can see further pressure building for the euro, but more importantly also strength for the US dollar. Now, if we have a look at some of the other euro crosses, so for instance, we look at euro sterling, we'll see that again, the negative themes have continued to materialize. Now, that's the 4-hourly chart, which highlights sort of a clear downtrend. If we have a look at the daily chart, you can see that we've seen a consistent failure to break above the mid-average of Bollinger Bands on a daily basis. And having broken, we highlighted the breaks below these lows as being a potentially significant signal within the longer term risks. So sterling outperforming and euro deteriorating has been a theme since the break lower, and there's really little to change that overall stance. So, I think, obviously the question is, okay, we're consistently posting new lows, but where is the next main support point? Well, there really isn't that much support when we look at euro sterling until we start to get back towards these lows that were posted in mid-February last year, around about the 82.90 level. So there's still potentially significant downside risks developing within euro sterling. We also look at euro CAD. So Mo was talking about euro CAD as an interesting opportunity as a reaction to the oil price. And we'll just this is the weekly chart that we've broken, or it's currently testing these last correction lows. But again, if we look at the daily chart, it's a pretty consistent downtrend signal. Yes, a short-term recovery this week. Sorry, excuse me. But there's still no evidence of any positive reversals developing, and that any upside is still set to be just reactive within what is an ongoing negative trend. So yes, we are overextended. Yes, we can potentially see some sort of reaction to that, but the overall risk is still suggesting that the euro is set to underperform on a pretty consistent basis across the board. Aussie, Euro Aussie, again, downtrend signals, momentum falling within a downtrend. So the overall risks are still towards lower euro, in my opinion. And that still seems to be very much a theme that's dominating the markets coming into the ECB tomorrow, and how we can expect the market to react. We may see a recovery on a short-term perspective, but the evidence still suggests, technically from a longer-term view, that risks are still skewed to the downside. Okay, so that's the euro. Just to wrap up over the next few minutes, I just want to have a look at the US market, because obviously the S&P is doing yet again what the S&P does best, and that's find buyers into weakness. We've failed to break below this last correction low. The rally this week is breaking above mid-average, so this is more constructive. It does suggest that we can have a retest of the all-time highs, and that we have now established a higher correction low. So the important support point to look for the downside is this 37.22 low, from which the market's now rallied. So if we do fail below this previous recovery point and put in a lower high, it would be breaks below this level that would suggest a more serious deterioration. So it's not an outright positive picture, and you could argue that if you look at volume within this recovery, the volume itself is declining and not maintaining the levels as we saw within the market sell-off of late. Now that is interesting for me, because it's obviously suggesting that the buying interest is not as significant. But if we look at traditional type of technical analysis, so we look at this as a possible head and shoulders top, so we've got this forming the left-hand shoulder, the potential head, this current rally possibly forming the right-hand shoulder, and the fact that we're seeing declining volume within that type of recovery would support that risk. Any break and close below this last low would again develop more negative themes and the risks for sell-offs developing. So, you know, the S&P, yes, it does look as though we can see further upside materializing within this positive trending condition, but there are still reasons to be slightly more cautious, and, you know, evidence to suggest that perhaps we need to watch price action more closely. Now, the Nasdaq has obviously suffered significantly over previous weeks, and you can see that the recovery hasn't really impressed that much. Now, against that backdrop, this really does suggest that this is a limited recovery. Now, if we're talking head and shoulders tops, I've seen some people highlighting this in the Nasdaq on a daily basis as a head and shoulders top. So left-hand shoulder, head, right-hand shoulder, traditional pullback, which is finding selling pressure developing. So again, the risk is that this potentially is a reversal area. So while yes, stocks have been performing well, there is still question marks to place over the overall setup that we currently have. So I think I would just be slightly cautious of stocks here, certainly with the Nasdaq itself, because we have broken these last correction lows and risks do seem to be skewing to the downside once more. And then just to sum up on the Aussie dollar, US dollar picture, just to look at some of the other crosses within the US dollar, we can see that Aussie US again has staged the recovery. Is this a head and shoulders top with this rally forming the right hand shoulder? Potentially. Are we in a neutral trending condition where the average is flat but parallel Bollinger Band? So again, this is a more balanced trading range. We would need to break below this potential neckline of a reversal area. But, you know, for me, it still looks as though the general themes are there for US dollar outperformance from a pretty consistent basis. Yes, we need to see a reaction against that, which is what we're seeing so far this week, but certainly coming into the ECB and the FOMC next week, this rally, if we start to peter out around this mid-average, for me would technically be quite interesting. If we start to break these lows, then this would look very quickly to be a pretty significant reversal in sentiment and suggest that the US dollar strength can continue and that we can see further development of those positive themes as other currencies suffer and correct against what have been fairly prolonged significant upside moves. So that's the technical backdrop for tonight. I'm just going to hand back to Chris, who's going to look at your questions. Thanks very much, Chris.
Thanks, Richard. Thanks, Maurice. That sets us up nicely, really nicely for the ECB meeting tomorrow. Just out of interest, Richard, on you're talking about the head and shoulders S&P and the Nasdaq. How does that correspond when you look at things like the Dow and the Russell that are making sort of continuously new highs?
Yeah, that's a great question, because obviously you do have the divergence where you are looking at certain sectors within the equity markets performing well and pushing to new highs. The only thing that I would say, and the red flag that really sort of is raised on that basis, is that there's a very old technique that technical analysis is based on called the Dow theory. And Charles Dow basically established certain rules, and one of them was within the US equity markets. And at the time, he was looking at transportations and the Dow, and basically saying that one indicator or one index had to confirm the other. So if one pushed to new highs, you would need to see those new highs confirmed by the other to suggest it's a much significant broader based move higher. So I'd say that while the Dow and the Russell are pushing to new highs, the fact that we don't have the Nasdaq confirming, the fact that we don't have the S&P, is just another sort of warning sign that we haven't got the type of confirmation that you would like to see to suggest that we're looking for a much more significant upside move. So I'd just say it places another question mark over the overall risk. We do need to see confirmation of these types of setups and signals, but it could be a warning signal that's developing there.
Thanks very much. Maurice, did you have anything to add to that sort of Dow up, Russell up, Nasdaq down, S&P somewhere in between?
Yeah, absolutely. I think you have to realize that every now and again we have two structures that are going on at the moment. We have what are known as growth stocks, which are the big cap tech stocks, and we have value stocks, and the value stocks are the Russell and the Dow, the industrials, the recovery stocks, the airlines and the rest of it, and the banks. Now, sitting in the middle of those two, you've got the S&P. Now, you have to remember that almost a quarter of the S&P is made up of tech stocks as well. And when you've got someone like Tesla in there that can move 20% in a day, then that obviously gets swung around as well. So the reason why you can have these different chart formations is because of the fundamental fact that some people are rotating from being just long growth stocks like big tech. They're selling their tech stocks, and they don't have to sell many to buy an awful lot of the Russell or indeed industrials in the Dow. And so you can actually, within one US stock market, if you like, within those sectors, you can have rotation going on, which can distort the charts in different directions. And that's exactly what we're seeing. So I think, you know, whilst it may seem strange, you can have a head and shoulders in one and a bullish market in another. This rotation could actually go on for a while yet. Remember, the market is very, very long tech stocks, and they have completely ignored for years the value stocks, particularly during the COVID crisis. And these value stocks are really coming back into their own now, as you saw in that chart I showed you of the Russell. So, you know, it is sector specific, and you need to be aware of how those sectors work and that they can almost work in opposite directions at times. Just the other day, we saw the Dow up 1%. The same day, the NASDAQ was down 2.7.
Oh, thank you very much. So we had a couple of questions just off regarding, are the webinars recorded? They are recorded. If you would like the recording, you need to speak to your Pepperstone representative and they can point you in the right direction. On the other side, Maurice and Richard were both talking about the Sunday night webinar where they're going to talk about the FOMC and obviously what happened at the ECB yesterday and how we closed the week. Sorry, ECB tomorrow and how we close this week. So that's this Sunday at 7. For those of you that haven't joined us before, that's this Sunday at 7 p.m. and the invites go out every Thursday. So look out for that tomorrow. Maurice, on the ECB, on the question of ECB meeting, would you ever go into the ECB meeting with a position, or do you reduce, or do you just cut your position? How do you approach an ECB meeting?
It depends what the sort of structure is too. I mean, this one, yeah, I mean, I've been sort of rather bearish the euro for a little while, and I thought we may get an extension of that into the meeting over the 2 days before it. Actually, it's not working that well. I expected us to be a little weaker than here, but we have seen a broad dollar sell-off today because of the lower US yields, which has pushed the dollar down today. But yeah, I do sometimes, if I'm not sure, and I think there could be a policy move, but it's not clear. I mean, basically the ECB usually do a policy move if the markets are pricing it. And when they do, you can actually get a little bit of a kicker in it as well. This meeting's a little more tenuous, but I do think she's going to be dovish. So yeah, I mean, I may have a position into this one, but I would not be risking too much through it. Depending on, you know, it's very difficult to gauge exactly how dovish someone is or how much is priced into the market. But I would think the market is a little bit short into this, so I would be careful and keep it fairly tight. But some of them I do, others I don't. It's very much a personal thing. Do your read and research and sort of check up on, you know, have a look at the European bond markets. Have they corrected back in anticipation of her being very dovish or even a potential move on the PEP? But I think I think more so on this one than I do in the Fed. The FOMC is a difficult one because, you know, you get such you know, such forward guidance from them that usually the move's already done by the time it gets to the meeting.
So when you were talking about the Dow and the rotation and things like that, somebody was asking, is that what you'd class the reflation trade?
I would say the reflation trade is a recovery trade in all but name. So yeah, I mean, I would say that would, I would expect to see global growth pick up in the short term. So industrials will come into their own. That's more the Dow and the FTSE with basic resources, mining, energy, all that doing pretty well. And then the pickup from the airlines, the services industries that service or front face, if you like, the consumer. I would expect those to start picking up now. And the other thing I think that will pick up, we had people say, oh, we had a fairly benign or weak CPI data today. You have to remember where this is coming from. With base effects, we could probably have quite a decent, strong number in CPI next month because of the base effects. The old data drops off. And the same thing with non-farm payrolls is that the weather was extremely bad for the, although it was a good number, the weather was very bad. That weather's getting better in the US. So we could have both a non-farm payroll boost next month and a higher CPI data reading next month. So April could be a big month for US data. And I think that's going to be very interesting coming up, see what that does to yields. One thing I would say, I don't think yields going to be here in a week.
Very true. What are the chances of yield curve control being implemented after next week's Fed meeting? And if you're able to put yield curve control into a very brief explanation for those that...
Yeah, yield curve control is where you're trying to control a certain part of the curve. Now, in Japan, we've seen the Japanese, because no one actually plays in that market anymore, they're actually controlling the 10-year. So what they do is every time the 10-year moves to 1%, they just buy all the bonds that are there to keep it there. So, you know, when it starts going above it, they're very active. They come in and they reduce the yields back to 1%. In Australia, they're working in the short end and the 3-year. And what they do is every time the 3-year gets to their benchmark level, they don't want it to go any higher. They come into the market and they buy bonds. And as bond prices go up, as you know, the yield will come down and they protect that. So that's yield curve control. So they're actually locking in the front end still, but then they don't allow certain parts of the curve to rise. Now, there is a discussion about the Fed going to have to do something with the yield curve and control possibly the 3, maybe even the 5-year. I don't think they can control the 10-year, and I don't think they'll try. But there is talk they might do something in the 3-year. Personally, I don't think that's going to happen. The market is split on it. I know some very, very clever guys who don't think they'll ever do YCC, and I've got some other very clever guys at some of the banks like Morgan Stanley who think, or I think it was Bank of America, are actually saying they're going to have to. They're not going to have a choice. So the market is split. I don't think we'll see it after this meeting. I think the Fed is very relaxed about what they're seeing at the moment. But we are seeing some quirks in, you know, everybody looks at the 10-year, but we had a very bad 7-year auction last week, and we saw the 5-year and the 7-year yields spike. So the belly of the curve moved up. Now that's what's called a bear flattener, and that's not good for risk. So we do need to keep an eye on the curve, but for me, I don't see them doing YCC after this meeting.
Okay, thank you very much. Richard, when you were talking about the technique that you were showing regarding the moving averages, can you use that in longer time frames? You had it on a 10-minute chart.
Yes, you can use it over any time frame, to be honest. I mean, obviously that changes your risk reward in terms of the longer term you go, the more significant the risk, but then obviously potentially the greater your profit becomes, because you're looking at longer term signals. But you can use it across any time frame. I just tended to find it more useful from an intraday perspective to highlight where the immediate trends were developing, and then build that into my longer term analysis, looking at sort of 4-hourly and daily charts, but not getting too sort of blinkered by the longer term picture. So if the averages were highlighting that trending and trading opportunity, then to try and take advantage of that from a shorter term perspective. But yes, they can be used along any time frames.
Okay, thank you very much. And how and what's your experience of how you're using that technique for currencies and commodities? Obviously you're using it on the S&P there, but is it similar for the currencies and commodities, or do you have to adjust it?
Yeah, no, it is similar, and I used it on the S&P chart in that example. But the important thing is that you have exactly the same conditions that are sort of driving trending signals within the market. So, you know, once you start to see a positive trend developing within an FX cross, then the moving averages will reflect that. And then we'll start to see those trending conditions beginning to pan out and highlight the trading signals in exactly the same way.
Okay, great. And can you combine that strategy with other indicators? And if so, which ones would you advise?
You can, but the whole strategy is really designed to, and it's not one that I've devised. I hasten to add, it was somebody sort of a lot cleverer than me maybe, but it's really designed to be a simple trending moving average based in trading system. So effectively, if you add other indicators to it, you tend to complicate the signals. Really, it's designed to be Roger's favorite term, a smash and grab trade. You're looking to take advantage of trending conditions and accelerating conditions within a trend within the various markets. So that is basically just using moving averages to generate those types of signals. So you can use other indicators, and if you use a Bollinger Band, you're effectively sort of still using a moving average type indicator. But if you use momentum turning up at the same time as you get the averages giving you a signal, then that would strengthen that type of buy signal. But I would tend to concentrate just on the moving averages and try not to complicate it too much.
Okay, thank you very much. Maurice, you talked about a Fed blackout period, and that's what we're in at the minute. What is a Fed blackout period?
Oh, yeah, sorry, I should have explained that. Basically, as you're coming up to an FOMC meeting, what they do is they put a blackout or a lockdown on all the Fed speakers. They're not allowed to speak publicly on monetary policy. And basically, it's about, I think it's about 10 days, maybe 2 weeks before the FOMC meeting. So basically, you won't hear any commentary about monetary policy from Fed speakers before. So it gives them a clear run in, so there's no second guessing or anything like that. So they're trying to keep it that when the Fed wants to say something, it's said at the meeting and it's not all released before.
It doesn't stop the market second guessing, I guess, right?
Certainly not. That's what we're paid here to do.
Fair enough. So why are the ECB expected to be so dovish, when they're moving out of lockdown? Won't they catch up fast to the US when potentially they start coming out of lockdown, maybe at the end of March? Or is that the problem?
Sorry, as far as they're concerned, not if their yields start rising, because basically, whilst the ECB would happily keep rates down and low for a long time, don't forget the market can raise rates for them just by selling bonds pretty aggressively, like we've seen in the US. The Fed hasn't raised rates, but yields have gone up from 0.8 to 1.6%. Now that's a rate hike in all sense and purposes, but the market's done it for the Fed. So the Fed sees that as it's not an official rate, it's not the short end, it's not the lending rate to the banks, it's the longer end that's doing this. Now, whilst the central banks can control that short end with some ease, it's very, very difficult for them to control the longer end. And especially when the US is happy with higher yields and we see global yields picking up, again, we get these higher yields in these weaker economies. Now, don't forget, the US is in a far better position than the EU is, and the EU still feels that their recovery is very fragile. Now, it may be recovering and they may have slightly higher inflation off a very low base and growth off a low base, but I think the forward expectations for growth tomorrow are going to suggest they are going to be in a short-term second recession. Now, that they in that scenario, they need the euro as low as possible and they need yields as low as possible right down the curve. And at the moment, they're losing the long end. So they're going to try and talk it down. And if they can't do that, they may act in the markets and do something about it. And that is why they are being uber dovish, is because they want their export base to improve, which means they need a weak currency, and they need their the lower yields to help generate growth within the economy as well. So that's why they're being rather more dovish than the Fed is at the moment, and probably for good reason, because that economy is sluggish. There's no two ways about it.
Okay, thank you very much. So last question of the night. We talked about on Sunday that the Bank of Canada decision was today. Did you see anything from the Bank of Canada decision that you thought was interesting, or is it maintain the status quo?
It was more or less the status quo, to be honest. I think realistically that they were expected to leave rates. We might hear from the central bank governor, I think tomorrow at some point, or the next day. Sometimes he does a press statement the day or two afterwards. It was pretty flat to me. I think they want to see what's going on with inflation. I think they feel their economy is still far from perfect as well. Quite happy with rates where they are, but they're maintaining their QE at the present rate of whatever it is a week, and they're going to continue with that. So still quite accommodative stance from the Bank of Canada there, but nothing really new that I saw anyway.
Brilliant. Okay, well, we'll leave it there. Thank you very much to Maurice and Richard. Thanks to all the attendees. Hopefully we'll see you Sunday. If not, we'll see you in 2 weeks' time. Have a great ECB tomorrow and week ahead. All the best.